announced over the last several months. But sales growth is going to soon be the key as well. The company is attempting to address in a number of ways. The stock over the last year into today up more than 80%. So investors at this point, they're going to want to see more than trimming some of the excess numbers to make the bottom line look better. They're going to actually want to see more growth on top two, Manus.
Abby, thank you very much. The magic words, dividends and buybacks in this earnings season. Let's stick with that because we've got Weight Watchers. The stock is plunging. This is after Oprah Winfrey said that she's preparing to leave the board. Natalia Kunijevic joins me now. The power of Oprah. Good morning, Natalia.
Good morning, Manus. Yes, Oprah joined the board in 2015, but this is not just related to Oprah's departure. The company posted disappointing guidance for the full year. They expect a big drop in revenue. They also lost about 200,000 subscribers last quarter, and there are lots of concerns for investors. But to take a step back, this is a company with a 50-year history. It was very popular in 1990s, 2000s, and historically, they also had lots of in-person meetings. So this is basically all about healthcare. They provide healthy diet plans. But now, as we can imagine, they are facing competition from similar companies as well as GLP-1 drugs. So three biggest concerns for investors. Number one, growth. Number two, liquidity. And number three is leverage. The company was able to get a very favorable refinancing during COVID-19 pandemic, but overall now it has leverage at 10 times. In terms of cash, in total, they have 160 million cash plus revolver availability. But when it comes to debt, it's $1.4 billion. And bonds, Manus, are trading at a distressed level with yields approaching 20%.
Evolution in the market. Natalia, thank you very much on the Weight Watchers story. Let's turn to the media space. Paramount shares, they're moving higher after posting a fairly upbeat set of numbers for streaming. AMC, not as fortunate, coming in short on the profit estimates. It's a battleground out there, isn't it, Simone? Good morning.
It is, and the test for both of these companies was putting on a show that the future quarters in 2024 could be better than 2023 when both of these names experienced losses. AMC, after losses, massive losses last year, not able to convince investors that it is really turning the quarter. Despite Taylor Swift and Beyonce concert shows, which brought a revenue up 11% year on year in its fourth quarter, it saw EBITDA that fell short of estimates by 4.5 million. EBITDA was only 42.5 million in the quarter. That led to a cut in target pay for the CEO by 25% this year. Citi says no surprise that this name is trading lower today, substantially the most since November, especially considering January, February box office was down 45% from pre-pandemic levels. Paramount, however, able to tell a little bit better story here despite mixed results. Its streaming business subscriptions rising about 4.1 million from the previous quarter, now 67.5 million. And it says its streaming service domestically will be profitable next year, even despite the overall revenue miss. We're seeing some enthusiasm in the shares today, now up about 6%. But there is concern here. KeyBank saying that with at least one potential acquirer halting talks recently, we don't see much to get excited about. Maybe the only thing to get excited about is that shares closed at their lowest since November yesterday. So this news a little bit a positive headline for the company.
Simone, thank you very much. Let's turn our attention over to the hardware side of the business. HP shares, little change after Q1 earnings came in line with estimates. Ed Ludlow is with me. Ed.
Yeah, it's a pretty mixed bag for HP. It's a story about PC on the consumer side and a story about PC on the commercial side. After basically 2 years of sales decline, the street was looking for HP to tell us that they would at least rebound in the consumer unit. What we got was a decline of 1% on the consumer PC unit, $2.76 billion, and on the commercial PC revenue, 5% decline to $6.5 billion. What's interesting is the narrative looking forward. HP is saying we expect to return to growth in 2024 on the PC side of our business, and that will be driven by enterprise or commercial customers. A lot of that stems from improvements in software which they can attribute and thank Microsoft for, some limited upside they see in PC sales coming from AI. There's a big conversation happening right now, Manis, about us interacting with generative AI tools locally on device, both on PC and on smartphone, but we're yet to see that materialize in a kind of upgrade cycle that's coming. I find it really interesting. So HP just recorded the end of the fiscal quarter ending January 31st, but it includes the holidays. And if you look at the third-party IDC data, and it's reflected in HP sales as well, it's the weakest holiday period for consumer PC going back to 2016. So we're kind of waiting and we're a bit nervous, even though the stock's up 0.2% after a decline in after hours when they posted the numbers.
Ed, thank you very much. Ed Ludlow there with the very latest on the tech stories. Now, Deutsche Bank's Vinky Chadha says this, weighing in on the equity positioning. Solid inflows again this week. It's the fifth in a row. The inflows over these 5 weeks have totaled $75 billion. That is the strongest in 2 years. Inflows this week again being driven in part by U.S. funds. Vinky joins me now. I mean, there is this sort of almost euphoric FOMO scenario. It reminds me very much of the meme frenzy from a few years ago. Vinky, good morning to you. When you look at this kind of movement in the markets, are you comfortable with the pace and velocity? Good morning.
Good morning, Manis. In terms of the flows, they're clearly robust, but I would rush to point out that they're actually coming in line with the macro data. I think big picture, you want to keep in mind that we've been growing above trend in the U.S. for more than a year and a half now. And we look set to do that again, basically for the 7th quarter in a row in the first quarter of this year. So yes, we're getting robust inflows, but they're just as robust as the macro data, basically.
Okay.
And in fact, I would go wider than just the flows, equity positioning or changes in equity positioning, which generally produce basically, very sharp moves when there are sharp moves in positioning, especially off of extremes. They're also in line basically with the macro data. So, if you want to find a boogeyman, it's the macro data has been good.
The macro data has been pretty stellar. I mean, again, this morning, PCE in line and real incomes there coming in, Vinky, and this is what the Market Lives team are talking about on the blog. They're talking about rising real incomes support the S&P outlook. Fear ye not for the consumer. And that chimes with you. You've got 5,500 as your target. Strong real incomes is a pretty strong pillar in this narrative, isn't it?
It's a very strong pillar. I think it's also important to keep in mind that, a big part of it, if you're looking back over time, over the last year and a half, where did we get this strong growth? We got it because oil prices came off. And so real incomes, got a boost, and real incomes have basically been growing since. What happened in the summer of 2022 is something pretty unprecedented in the sense that we had real incomes falling for about a year. But the inflection point is really, post the Russia-Ukraine boost in oil prices as they started to come off. Real incomes basically began to grow again. And that, in our view, has really been the driver of the very strong growth that we've had. Now, inflation's come off, and so we are now talking about, much smaller sort of declines in inflation going forward. So that boost is going to taper off, but there's plenty of others that could boost growth. I mean, number one that comes to mind, of course, is destocking. Almost everybody and every company says that it's over, but it's not clear, universal or widespread signs basically of restocking. So that still has to happen. And that, I think, will, be the next, basically, one of the next, carriers of the baton, if you want.
No, that's fine. And also, I think what you said sort of chimes with what Collins, Williams, and Bostic made clear yesterday. Is it's going to be a more uneasy path to 2%, and we're playing for the long game, according to Bostic. Tell me what you make of this. Over at the House of Bloomberg. Over at the House of Goldman, they have this to say. They're breathless by the euphoria, one should say. We've gone through a period of euphoria, which has proved impossible to call a top. March suggests a fuller house. The rally is tired, Binky. However, there is no catalyst for a potential sell-off. Now, this is the kicker, Binky. This is where I want to spend our last minute and a half together. This has left the market participants unhedged. Are we naked? What is a smart, defensive, tactical deployment in the market that is a hedge?
I think given everything that's basically going on, it's not easy to really find that hedge because, first, but just stepping back and before we get totally into the hedges, what I would say is that, we are very, very close followers of positioning. We have a weekly report that I highly recommend, actually, produced by one of my colleagues. And I think the important thing to keep in mind is that, yes, positioning is clearly overweight, but if you think about it as a z-score between -1 and +1, we're sort of in the middle of the upper half of the range. Typically, when there is euphoria, you would expect to see equity positioning all the way at the top. We are clearly not there. In fact, we are kind of where we were basically in July, maybe a teensy bit lower, teensy bit higher. So, the aggregate measure of equity positioning does not suggest euphoria. I think from a demand supply point of view, in terms of thinking about equities, you've got to think basically about the other drivers in the demand supply. And I would highlight really buybacks, which are, enormous driver from a demand supply point of view historically. And what is going on with buybacks is that in 2022, so all the way back in 2022, when earnings were falling, buybacks also fell. But in 2023, as earnings recovered, buybacks did not. So there's a lot of room for buybacks to rise. We can discuss, why buybacks didn't rise. But I think the key point here is that what we got from Q4 earnings is that buybacks are now picking up. So they have room basically to rise. And they're a very important driver, basically, I would say.
Binky, fantastic context around the overuse of euphoria, if you look at it through the prism with which you have just presented. It gives me heart for deployment into one more rally in this market. Binky, thank you very much. That is Binky Chadha over at Deutsche Bank. Be careful how abused you are with the word euphoria. Coming up on the show, Bitcoin reaches for that record high.
It's a bullish environment when it comes to Bitcoin. I think it speaks to just overall risk-on environment that we're seeing from tech and others, where unless you have a telescope, it's hard to find this recession.
Conversation ahead on Bloomberg.
it's a bullish environment when it comes to Bitcoin. I think it speaks to just overall risk-on environment that we're seeing from tech and others, where unless you have a telescope, it's hard to find this recession.
Risk on everywhere. Thing of beauty. Bitcoin outperforming stocks so far this year. Investors are turning to alternative assets amid a wider caution in global markets. The token jumping 45% in the past 2 months, bringing the pandemic era record high of $69,000 into view. You can smell it. Katie Greifeld is with me for more. What's driving this, Katie? Is it events within the space? Is it flow? Just give me the various components.
Well, this one is interesting because it comes amid not much action in the equity markets. Of course, we're hovering near those record highs on the S&P 500, et cetera, but you're not seeing the big, huge moves that typically accompany the risk-on appetite that you're seeing in Bitcoin. But I think it really comes down to supply, demand, and leverage. We know there's a lot of demand for Bitcoin right now. You can see that in the ETF flows. A lot of assets or a lot of fund flows competing for Bitcoin right now. Supply is an interesting one. We are approaching the halving, of course, that's expected in April. Basically, at that point, the block reward for miners will shrink. It will be cut in half. So people are thinking we're going to have some supply constraints on Bitcoin as well. And let's talk about leverage, because I think this is really an interesting and important part. You have aggregate open interest on Bitcoin derivatives, which can be levered up to 100 times, Manus. On centralized exchanges, that's risen nearly 90% since October. That's probably exacerbating some of the moves that you're seeing right now to the upside. We'll see what happens on the downside when this rally, if this rally breaks.
Can I just say, as a former broker, that just the thoughts of that scale of leverage, it's salivating, quite literally.
I would imagine
You
so.
just write the tickets and it's 10 times bigger than you thought you were ever going to do. You talked about the dominance of some of the new players and the new entrants into this market. I mean, how dominant are the players? The flow is quite significant since the ETF was christened.
Yeah, the flows have been really impressive, I have to say, so far. You take a look at the BlackRock product, the Fidelity product. BlackRock's taken in $7.2 billion so far. It only launched in mid-January. Fidelity not too far behind. We're talking about $4.7 billion there. And then you have a solid middle class, as Eric Balchunas over at Bloomberg Intelligence would call it, also taking in more than $1 billion. So I think that demand for these spot Bitcoin ETFs have really surprised many across industries. On the other end, you do have the Grayscale product. That's lost about $7.8 billion so far. A lot of pent-up demand for selling, since in its prior structure, redemptions weren't allowed. But even with that, you're taking a look at net inflows for these spot Bitcoin products, and that's definitely contributing to the price, but also the euphoria around this asset class right now, Manus.
Okay, Katie, well, let's see what Mr. Novogratz is going to say later on in the day. There's a few of them coming out calling for a doubling in Bitcoin over the next 18 months. Himself and Skybridge Capital, I'm sure, are in the pack. Let's get the sector price action. Abby is with me.
Manus, we are looking at a 0.4% gain for the S&P 500, and it's a broad-based gain. Most sectors for the S&P 500, 10 to be specific, are higher, led by communication services. Some of those mega-cap tech stocks up 1.1%. We also have a nice pop for real estate with yields in just a little bit. Materials, tech, the one lone sector that is down, healthcare, down about 0.3%. So nothing too big there. Now on the month, because we are, of course, on the last day of the trading month, and most sectors are higher. Consumer discretionary, the best, up 8.2%. Industrial, so some breadth on the month, up nearly 7%. The one lone sector or subsector, take a look at that KBW Regional Banking Index on that New York Community Bank Corp blow up on the increased reserves around commercial real estate loans. Well, it's down 2.5%, Manus.
Okay, Abby, thank you very much on those moves. Coming up, we'll set you up for the events for the rest of your trading day, right here on Bloomberg. understand the deflator is to understand the core of what bond markets debate. This is the shift lower. It's not exactly dramatic, but this is when inflation, PC, is well behaved, goes in line. The market reacts solidly. This is about bond yields beginning to perhaps top out as we see that well-behaved PCE. And the market still believes that June is live for a rate cut. The transference is to the broader market. As inflation is behaved, disinflation remains the narrative, so the broader context of the Russell expands by 1.3%. That's the dependence on rate cuts for the Russell narrative. The rest of the markets remain firm. Nvidia also strong on the day. So at the moment, yields down, stocks higher. The correlation is very real. Stocks are rising. We'll hand you over to the rest of the team for your trading diary. In the meantime, Raphael Bostic speaks a little bit later this morning. We'll get more Fed speak. Goolsbee, Mester and Williams reaffirming, I suppose, the long road to cutting. Dell reports the earnings after the bell. Friday, University of Michigan consumer sentiment, and we get the ISM manufacturing. That's it for Countdown to the Open right here on Bloomberg from New York. I'm Manish Krenny. The rest of the team will carry you through the rest of your trading day. Good morning.
Minutes into the U.S. trading day on this Thursday, February 29th. Here are the top stories we're following. Inflation relief. Wall Street breathing a bit easier after PCE inflation data comes in as expected. Stocks rally and yields dip to the moon. Bitcoin climbing back to all-time highs as billions continue to flood into spot Bitcoin ETFs. We'll break down which funds are seeing the most love. And hotels at all-time highs as revenge spending continues to boost bottom lines. Hyatt CEO and President Mark Hoplamazian joins us for an exclusive interview in just a bit. I'm Katie Greifeld in New York. Welcome to Bloomberg Markets. You take a look at these markets right now. You can see there is green on this screen behind me. You take a look at the S&P 500, or up by about 0.5%. Not a huge move, but compared to what we've been seeing, a little bit exciting here. You take a look at big tech, the NASDAQ 100, actually seeing a bigger gain, up about 0.8%. Of course, we've been talking about that inflation data coming in as expected, a bit of a relief there, and you can see that in the bond market as well. Again, not huge moves that we're talking about, but it's the direction of travel. You have yields moving lower right now to the tune of 3-4 basis points on your 10-year Treasury yield, of course, after the Fed's preferred gauge of underlying inflation. We're talking about the PCE. It rose in January at an as-expected pace, supporting the Fed's patient approach. And for more on that data, we're joined now by Bloomberg's Mike McKee. So after what we saw in CPI, this probably good news for the Fed.
News for Wall Street. You probably heard that big whoosh at 8:30 as Wall Street exhaled. Yes, the PCE was a little bit higher than it has been in recent months, but it is not too high. And on a year-over-year basis, inflation is still going down. We saw PCE rise by 0.3% on a headline basis during the month of January, and 2.4% down a tick from the year-over-year perspective. On a core basis, 0.4 rise, 2.8%. But both of those lower than they had been. The disinflation story continues. Personal income was up a great 1%. A lot of that due to the dividend payments that went out at the end of the year and the beginning of January. Wages and salaries were also up a decent amount. The dividend thing is kind of interesting, Katie, because what we saw was a big increase in portfolio management. Again, Wall Street's been doing so well that it is contributing to inflation. We were up 5% for that category of inflation, also helping drive it. But as you can see, the percentage change is much different. Housing and healthcare as they have, but we didn't get the big housing pop that we saw in the CPI, which made people feel better. So what now? Well, we've got more data coming up, but Jay Powell is going to be the issue going forward. He testifies on Wednesday and Thursday, I believe, of next week, and we will be carrying that live. That's really going to be the risk moment for markets in terms of the Fed trying to reset perceptions.
Yeah, he'll actually be testifying during this show, so a lot to look forward to there. What could we expect him to say? What do you think the tone of that testimony will be?
Well, after this PCE report comes out, relatively decent, and we did see December revised lower, he can make the argument again that inflation, the progress is being made on inflation, but there's still more work to do. We have a little bit higher monthly inflation in January, so we want to wait and see if that continues into February. We'll get a February CPI report before their next meeting. And so I don't expect a whole lot different, but markets have been very interested in whether or not the Fed is going to give them guidance about May, June, or even in July as a first rate cut. So we'll see what he has to say.
And it's always fun to hear what lawmakers ask Jerome Powell as well. So that should be a lot of fun. Bloomberg's Mike McKee, thank you so much. And let's take a deeper dive into the markets right now, because I'm pleased to say we're joined now by Mandy Zhu. She is head of derivatives market intelligence over at Cboe. Joining me on set, Mandy, it's great to see you.
Great to be here, Katie.
So it's a big macro day, and it's interesting. If you look over the course of 2023, it feels like the FOMC, CPI, some of these jobs days, they've turned into non-events. That's changed a little bit year to date if you take a look at some of the numbers here. What does that tell you? Is that maybe a sign that broader volatility is coming back, or how are you reading that?
So what actually stood out to me was in the lead up to today's PCE was just how much, there was lack of fear across all asset classes in terms of levels of volatility. So if you look obviously at equity vol, VIX in the low teens in the lead up to PCE, but not just equities. If you look at credit volatility near historic lows, FX volatility also multi-year lows. I think what that shows is that investors, yes, sticky inflation clearly is still an ongoing risk, but on the back against that, people are weighing, better than expected economic data, and I think that that's why markets have been so resilient year to date, is that even though inflation, as we saw today, it's coming down, it's making progress, but it's still sticky, but overall economic growth is picking up, right? And within equities, earnings have been great. So I think against this backdrop, people have gotten a lot more, I think, constructive.
And when you think about, what we're seeing in the VIX, what we're seeing in some of these skews, do you view that really as complacency or exuberance? I mean, how would you characterize the fact that you don't see a lot of demand for these downside hedges?
That's a great point. So to give you some perspective, measures a skew in the S&P, so that measures the demand for downside puts versus upside calls. That hit a 10-year low recently, right? So there's very little demand for the downside protection, and there's actually right now a lot of demand for those upside calls. Is this a sign of exuberance? Perhaps. But one thing I would point out, and I think that is kind of what is underpinning this flat skew or low skew environment, is that actually over the past 2 years, markets have been more volatile on up days than down days. It's very unusual. Typically, we think about, stocks, crashing lower and grinding higher. And over the past 2 years, it's been the opposite. We've seen grind lower, moves and then rip higher, right? Think about Q4 last year. Yeah. So against this backdrop, I think it's not surprising that people are turning more to call options to help manage that upside volatility, that upside risk in the market.
Should that make me worried? I mean, when I hear that, it sounds like, okay, maybe we're entering this crash up environment again. You're really not seeing the demand for downside protection. I mean, how are you thinking about it? How do you feel?
Yeah, so I think, it comes down a little bit to positioning and just how overweight people are in equities. And I think a lot of it comes down to people using options to help express these tactical views, right? Because there's still so much uncertainty with the macro environment, instead of kind of going all in, what they're doing is actually using options to really help manage that risk. So buying call options, if you think the market's going to rally, if you're wrong, you're losing just the premium paid. So having that defined risk reward with options, I think that's kind of what is driving some of the dynamics that we're seeing in the derivatives market.
And this increased use of options and the fact that you're seeing shorter and shorter term options come into popularity. I think you know where I'm going, 0-day options. I mean, what does that mean for the market structure of this market? I mean, do you view that as distorting maybe some of the traditional measures of risk that we look at?
So that's a great point. So I think people often talk about 0-day options. Obviously, we've seen tremendous growth in that segment. It's now comprising about 45% of all S&P volume, up from 5%, say 8 years ago. A lot of people look at that growth and say, well, it must be taking share from the traditional tenors and traditional use cases, and it's actually not the case. So the overall pie in terms of derivatives volume is growing, right? So 0DTE is obviously growing faster, but the rest of the pie is also growing. So if you look at our regular third Friday expiries, the non-0DTE expiries, that's also growing in terms of volume. So people are still using 1 month, 3 month, 6 month options to express those longer term views. Is that just 0-day options kind of opens up a whole new risk premium for investors to express a view on.
I'm curious to get your perspective on who is actually using 0-day options, because a narrative has emerged that it's mostly retail players sort of YOLOing into these bets. But is that true, or are we also seeing some of these professional money managers, these institutions also using this?
Absolutely the second case. So I think the narrative that this is an extension of the meme stock era of 2020, 2021, but what we're actually seeing in 0-day options, it's a very balanced flow between retail and institutional, and it's actually balanced between trading of puts versus calls, right? So the put-call ratio for 0-day options has consistently hovered around 1 versus, like longer dated tenors, it's a totally different story. So it tells you that, people, in terms of the activity that we're seeing in 0-day options, it's not one-way speculative, flow in terms of where the market is going. People are using it for hedging purposes. People are using it for yield harvesting purposes. So actually selling these options to generate income, that's been a growing use case. People are using it to replace futures, trading of futures. So I think given the diversity of use cases, that's why we're continuing to see very balanced flow in 0-day options. And because it's balanced, the net market impact is actually fairly de minimis. So a lot of the headlines you see out there, I would say, is very exaggerated.
Right. So it's good that we're doing some myth busting now, and you're sticking with us. But I do want to ask, when we talk about, again, this lack of demand for downside protection, should there be? I mean, should people be picking up protection on the cheap right now?
Certainly, I think if you are concerned about downside risk, now's a great time in terms of just what the volatility market is giving you, right? The lack of the put skew in the market. I think that it is a good opportunity if you're looking to hedge. One area I do want to call out for those people, if you talk about this no demand for hedges, we are seeing demand for hedges in VIX options. So VIX option volume actually hit a record high last year and continues to to be very elevated. So people are looking to VIX options to hedge tail risk, right? So potential kind of that black swan event hitting the market, driving volatility significantly higher. So that's different from your traditional portfolio hedging where you're hedging a 5 to 10% lower move. So we're seeing increased demand for tail hedges and kind of decreased demand for the traditional hedging strategies.
I gotta say, that's really interesting because the VIX has been going nowhere fast, so a little bit unintuitive there. But Mandy, like I said, you're sticking with us. Let's take a quick look at what's moving underneath the markets right now. We're gonna do that with Bloomberg's Emily Grafeo. And Emily, Snowflake melting.
Yes, exactly, Katie. The biggest drop on record for the cloud software company, down over 20% after their sales forecast missed after the bell yesterday. They see their product revenue now coming in at $745 million to $750, and that was versus estimates of $769.5 million. Snowflake also said that their CEO, Frank Slootman, is stepping down, and now the Senior Vice President of AI, Sridhar Ramaswamy, will be stepping in as CEO. So it's interesting. Maybe there'll be some more AI headlines out of Snowflake now that someone who was in charge of that strategy is going to be coming in as CEO.
Yeah, they could definitely use an AI headline right now. Of course, sales, the shares down quite significantly at this point. Not exactly the same story for Salesforce, though.
It's been a choppy trading session. It was down in the pre-market when you look at Salesforce. Now it's just a little bit in the green this morning while slipping into the red as well. Their 2025 forecast missed estimates, which it seemed like a lot of investors were kind of hanging on to in the pre-market. They see revenue at $37.7 billion to $38. That was a little bit worse than expected. It's also interesting here for Salesforce. They were up over 80% in the last 12 months, and now a lot of investors seem to be focused on what is the growth rate going forward. An analyst from RBC said, is the sustainable growth rate in the single digits or the double digits? Similar story for Snowflake. Companies have simply been pulling back their spending on software. So all of these software companies are now really trying to pivot their strategy and look for what they can actually do to get that market share back. At least for Salesforce, on Tuesday they announced a new AI tool. It involves generative AI, a lot of buzzwords. So that seems to be their strategy to get those enterprise customers back into their market share.
Yeah, we'll see if that leads to more engagement, though. So Salesforce not doing too much right now, but when it comes to Bath and Body Works, I mean, the direction of travel pretty clear here.
Yes, biggest intraday drop since November 2022 for Bath and Body Works, paring losses a little bit, but their earnings missed expectations. The first quarter forecast, they see EPS at 28 cents to 33 cents versus estimates of 38. Also, their net sales forecast, they see down 4.5% to down 2, and that was versus estimates of just a loss of 1%. Their fourth quarter revenue, their results actually beat there on adjusted EPS and net sales, but overall, it's been a tough go for a lot of these retail companies. Of course, we know Bath & Body Works. They have candles, hand sanitizers, lotion. I just read in a note that now they're trying to pivot more towards laundry products in kind of a way to maybe boost their sales. Maybe that's more of a cyclical product. Laundry, everybody needs laundry, but maybe you pull back on buying a candle if you're a little short on cash, Katie.
I thought for sure you were going to say they're pivoting into AI.
Into AI. Maybe next quarter.
Yeah, we'll see, of course, if the trajectory continues. Bloomberg's Emily Grafeo, thank you so much. Now coming up, Bitcoin soars over $60,000, pushing towards a new record high. We're going to take a look at what's driving that rally and if it can keep up the momentum. This is Bloomberg. Well, Bitcoin is on its way back to the moon. You have prices of the cryptocurrency climbing back towards record highs as billions of dollars flood into the newly launched spot ETFs. For more on this, we're joined by James Seyffert of Bloomberg Intelligence. And James, I mean, you take a look at some of the numbers, the fact that we're well above 60,000 once again on Bitcoin. Do you think we would be having this conversation had we not finally seen the launch of those spot Bitcoin ETFs?
Yeah, I mean, being virtually at all-time highs, I mean, we're still $6,000, $7,000 off of that. But the catalyst here has undoubtedly been the ETF approval. I mean, even if you look at from when the thing started really looking positive and we upped our odds to 90% of approval, this thing was still under $30,000 back then. So a lot of the run-up, even to the launch, was due to people expecting an ETF launch. And the flows have just been basically living up to the hype and then some.
And the flows really fascinate me, James, because as you know well, of course, when it comes to a lot of the platforms, when it comes to the big wirehouses, for example, it's not necessarily that these products are approved with a full stamp of approval, and yet we're still seeing the billions of dollars of net inflows.
Yeah, I mean, we're at 7.4 on a net basis. There's been a bunch of money that came out of GBTC. Some of that likely came to these other products. But we have IBIT from iShares that's over $9 billion in assets. It's taken in over $7.1 billion so far since launch on January 11th. If you look at the year-to-date numbers, IBIT is number 3. The only thing ahead of it is VU and IVV. It's taken in more money than the Qs. And you don't have to go very far to find FBTC down there. These things are trading as much as some of the most traded ETFs in the world right now. I don't know how much longer this can go on, but anyone saying that these things were going to be a flop or were a flop, they've been proven completely wrong here. No other way about it.
Well, on the other side of that, plenty of people also taking a victory lap right now. James Seyffert of Bloomberg Intelligence, thank you so much. And remember, tune in today at 12:30 p.m. for an interview with Mike Novogratz, Galaxy Digital CEO, perhaps also taking a victory lap right now. But before we get there, we're back now with Mandy Zhu, Head of Derivatives Market Intelligence over at Cboe. And I won't ask you about crypto, I promise. But let's talk about China. Of course, when it comes to a lot of these China-related ETFs, you see a lot of excited action, particularly in the options space as well. We know that the Chinese stock market, it's been a big question mark all year and continues to be. How are you viewing some of the activity that you're seeing there?
Yeah, so we definitely noticed very bullish sentiment in a lot of the Chinese ETFs and a lot of outsized call buying. I would characterize that as more bottom picking rather than high conviction view that China is really headed for a durable rebound. There's clearly still a lot of policy risk and then obviously a big question mark in terms of their economic growth outlook. But taking a step back, I would say what really stands out to me in the derivatives market right now is that people are using options to play this potential broadening out of the equity rally, right? So far, it's been very much dominated by the mega cap tech names. We're now seeing people, probably still staying in terms of core allocations with tech, but using options to play, kind of look for potential laggards and where we could see a rally. So in the U.S., that's been small cap equities, and internationally, it's been a lot of the ex-U.S. indices in China, of course, but also more broadly speaking, Europe, Japan, etc. So that's definitely been a notable theme. And on that front, we're very excited to be actually launching options on 3 new MSCI indices, so MSCI ACWI, MSCI World, and MSCI USA next month to kind of help investors navigate and play that theme.
Well, let's stay international here. Let's talk about emerging markets specifically, because we've been talking about low volatility in the U.S., but when it comes to emerging markets as well, vol has been particularly low, which isn't something necessarily you associate with EM, to say.
Yeah, so if you look at the VIX for the MXEF, the Emerging Market Index, the spread versus the VIX versus S&P really blew out early January when China was going through, its turmoil. But since then, it has definitely come in quite a bit. So I think that as the outlook for China improves, as we see more policy support for the region, I think there's a lot of question, obviously, if EM can really decouple from China. I'm not convinced it can. At least in the volatility front, what we've seen is that when there is particularly heightened China risk, EM volatility picks up. So at least on the volatility front, it has not decoupled.
Yeah, it's so interesting. I feel like when it comes to EM, especially in the last couple of months, I keep having this unbundling conversation that, okay, I talk to a lot of people who are bullish on EM, but it's EM ex China. Maybe your conversations sound like that as well.
Yeah, definitely, for sure. And I think one thing to keep in mind, and if we take it, again, a step back into the broader macro impact, is I actually think China and what is going on in China could have a dampening effect in terms of inflation, right? So, weaker growth prospects coming out of China is one reason why oil prices and commodity prices so far have been very, very tame, right? Despite the geopolitical risks out there. And China's kind of industrial policy of subsidizing exports means we'll probably see, greater than expected goods deflation. So I think that, when we talk about Fed policy and the path forward for inflation, I think China's definitely, an outlook for China is going to play a big role in that.
So we've talked about China, we've talked about the U.S., we've talked about EM more broadly. We haven't talked about Europe, I don't think. And I don't know, you hear the random call for Europe's going to outperform the U.S. this year, et cetera. Are we seeing any positioning along those lines?
Not so much in Europe, and I think that's because the European backdrop and the European growth story is not there yet, right? So in terms of so recent data has certainly come in better than expected, but the outlook for the year is certainly weaker growth out of Europe, and actually also more persistent and sticky inflation there. So we'll see what happens in that region, and also keep in mind that Europe is the region that is most exposed to China, much more exposed to China than the U.S. So if you're expecting weakness in China, Europe is probably not the region you want to be in.
So maybe it's not the year for Europe, but one of these years. Mandy, gotta leave it there. Really enjoyed this conversation, one around the world. That's with Mandy Zhu of Cboe. Now, still ahead, we're going to take a look at the companies making the most social buzz today. That's our Social Climbers segment. Up next, this is Bloomberg. All right, time now for Social Climbers. A look at the stocks making waves on social media this morning. And first up, we have C3 AI. It's getting a lot of social love after reporting sales that suggest that the customers are responding positively to the company's new AI-based apps. And Bloomberg Television will be speaking to the company's founder and CEO today at 4 p.m. New York time. Now, next up, we have Best Buy reporting sales that beat expectations. The electronics retailer is in the midst of reversing a 2-year slump thanks to soft softening demand for electronics and appliances. And finally, this is a really interesting one. We have Weight Watchers International. It's shedding more than just its share price. Oprah Winfrey leaving the company's board. Of course, that is a fresh blow to a company struggling to compete against obesity drugs. And remember, Oprah recently revealed that she used these drugs as a maintenance tool. She did not specify which one. I'm sure a lot of people would love to know, but Weight Watchers currently off by about 24% right now. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Now you take a quick look at these markets right now. It's an up day, a small one, but an up day nonetheless. You have the S&P 500 currently up by about 0.3% more so if you take a look at big tech, with the NASDAQ 100 higher by about 0.6% as volatility continues to fall, and so do yields. Coming up, Hyatt on a 6-day winning streak since beating estimates last week. We have an exclusive interview with the company's CEO next. This is Bloomberg. Well, we're keeping an eye on travel stocks today as they approach multi-year highs. Bloomberg's Natalia Kunijevic is tracking the moves.
Hi, Katie. So this chart shows stock prices for Hyatt, Hilton, and Marriott. We see how quickly those shares recovered after the pandemic. Overall, big trend is very positive. However, let's dive deeper and look at weekly sales. Bloomberg has an amazing tool. It's called Bloomberg Second Measure Weekly Observed Sales. And we see a slowdown here. This is as of the week ended on February 18. So the biggest decliner here is Hyatt, minus 22%. The smallest decline was for Hilton, minus 3.5%. For the industry overall, the median decline was at 11%. So definitely there are some concerns for customers. Maybe it is a affordability question, inflation, and so on. It's also really good to look overall globally, compare demand across different regions. So Bloomberg NEF tracks jet fuel demand for passenger airlines across the world, and they say that 3 regions will account for the biggest gain this year. Those regions are Asia on top, North America, followed by Western Europe. But they say, Bloomberg NEF, that this post-pandemic rebound is kind of slowing down and probably growth will be muted. So it's really interesting to see if it will be translated in stock prices that we looked in the beginning.
All right, Natalia, thank you so much. And for more on travel and leisure, I'm thrilled to say that we're joined now by Hyatt CEO Mark Hoplamazian. Hyatt, of course, reported earnings last week. And Mark, I want to bring you something that you said on the earnings call, and that is, quote, we don't need to be the biggest in the industry to be the best because we have and will continue to play the game differently. How is Hyatt playing the game differently?
Well, I think in multiple, first of all, Katie, nice to be with you. Thanks for having me. In multiple dimensions, we have really focused very intensively on the high-end traveler. And we've significantly expanded our luxury and our lifestyle and our leisure portfolios over the last 5 years. Part of that has to do with the fact that we've been selling real estate, hotel real estate off, and redeploying that capital into acquiring platforms and businesses that have yielded tremendous results. So if you look at 2023, for example, the businesses that we acquired earned roughly twice the amount of money that the hotels that we sold in order to buy those businesses had made. So we've significantly expanded shareholder value, but most importantly, we are applying our core purpose as a company, which is caring for people so they can be their best, into how we differentially care for our corporate customers, our guests, our colleagues, and all of that translates into great results for hotels. So it's a very, it's a mutually supportive value chain that we've created. And over the course of time, we've added a lot of great brands to our portfolio.
Well, I want to get to the asset sales, but let's talk a little bit about the high-end traveler a little bit more, because of course you did grow your net rooms, but you also grew fees per room. We talk about pricing power all the time on this show, but when it comes to that high-end, that luxury traveler, do you still have that pricing power?
Yes. When you look into the future, the data that we got is somewhat short-term, but our pace, that is forward sales in the first quarter for our resorts throughout the Caribbean and Mexico are up 11%. And our forward sales for group business, that is larger convenience and so forth, is up 8% for the whole year. And business transient, which is already above pre-pandemic levels in China and in Europe, is increasing in the United States. And there's tremendous ability to maintain and grow pricing. So in every one of those cases, those increases include both some increase in occupancy, but also increases in average daily rates. So we're seeing continued growth in rate across all of the demand groups that we serve.
Well, I found this conversation really interesting because if I take a look at your average occupancy, it's still lower than 2019 levels, but it sounds like you've more than made up for that on the pricing side.
That's precisely correct. Some of the areas that it's been lagging the most is in our large convention hotels, where we are 4 to 5 points of occupancy below where we were pre-pandemic. So you're absolutely right. Total revenues are up, and it's been largely driven by rate. I think we will see a more balanced increase in 2024 than we had before. Our own situation is that we grew our revenue per available room in 2023 by 17%. And so our outlook that we mentioned on our earnings call last week was up 3 to 5% for 2024, which sounds dramatically lower than the 17%. But remember, that's off of a base that's much higher going into the year. So it's continued momentum, positive momentum across the board and across the globe.
Well, Mark, I'm curious, do you see returning back to those 2019 levels, or has the nature of travel, especially when it comes to things such as conferences, for example, has the world fundamentally changed there?
No, we are already above 2019 levels in revenues for group travel, and I think I think our occupancy opportunity and further rate opportunities will leave us ahead of 2019 levels in group. For sure, in leisure, we're operating somewhere between 20 and 30% higher than where we were pre-pandemic, and business transient will fully recover in the United States. It's already above pre-pandemic levels in Europe and China, but I have every confidence, and we're seeing positive momentum in individual business travel in the United States this year to date in the first quarter. So it gives me encouragement to know that we're on our way to having full recovery and really not just getting back to 2019 levels, but actually building beyond those.
Well, I have to say, at least in Miami, it feels like there's a conference every single week, especially in February, but that's a different conversation. Let's talk about what else we learned last week in Hyatt's earnings. Of course, it seems like Wall Street was particularly jazzed about the 80% sale of the Unlimited Vacation Club business. I want to talk about why, though. Does this necessarily alter your strategy, or was this more about simplifying your disclosures?
Well, you're obviously paying a lot of attention. It was about simplifying our disclosures. It's a great business that's integrated into our all-inclusive business. The club itself, excuse me, provides tremendous benefits to its members, and it's been growing at a very healthy rate over the last 5 or 6 years. So it really is a great additive value for the members of the club. It's also great for hotel owners who have who invite those members into their club, into their hotels, and they are high spending and very frequent travelers. The issue with this business is that it's a subscription model, which has accounting associated with it that has a lot of deferrals in it. So you recognize 100% of the expenses up front, and the revenues get amortized over time, even though you've collected the cash. And we thought we've explained it many times, but there's no substitute for simplifying it. And that's actually what we did through that transaction.
Well, Mark, I appreciate you explaining it again. And I only have about a minute left with you, but I am really curious to get your thoughts on this narrative of revenge travel, revenge spending. That's been used to explain a lot of what we're seeing in the entire travel industry. Is that what you're seeing as well? And if that's the case, would you expect it to peter out from here?
Yeah, I think I would say we can retire the word revenge travel and talk about the fact that people are so connected with the feeling of being able to be mobile and going out and experiencing different things. Excuse me. I'll just give you one example, which is quite amazing. When Taylor Swift did her three concert stay in Chicago, the city exceeded its peak hotel revenues by a wide margin in the entire history of the city. And so this Taylor Swift effect is absolutely real. Why? That's not revenge travel. That's like seeking out a great experience that people will say, yeah, I'm going. Yeah, I understand it's going to cost me a lot of money, but what an experience I'm going to get. And I think that's true in leisure. I think it's true on extending business trips. I think it's true in convenings. I think our meetings, our corporate customers are really leaning into unique experiences during their meetings. So it's really going towards more experiential and prioritizing that and being willing to spend.
All right, that's a good place to leave it there. Taylor Swift and Economic Force. Mark, really appreciate your time. Enjoyed this conversation. That is Mark Hoplamazian, the CEO of Hyatt. Of course, Hyatt trading close to an all-time high right now, as to are many of its peers. The travel industry just on fire right now. But let's see if the broader market is on fire as well. We're going to do that with Abigail Doolittle.
I don't know if I would call this a fire, but I would call it a modest bullish bump, Katie, because if we take a look at the S&P 500 E-mini futures overnight, you can see overnight a little bit of weakness, not a major decline, but into that PCE number that came in line, some relief. You can see this rally higher to up about 0.5% at one point, then down almost. It seemed like we were going to potentially turn negative, up about 0.1%. Right now we're up about 0.25%. So it's going to be interesting to see. If you take a look at bonds, not a lot of movement there. So it'll, as the day goes on, let's see what investors do. As for some of the individual movers beneath the surface, take a look at Oak, for the software company, soaring up 20 2%, the best day since December of last year. They put up a good quarter. Outlook, B of A, did upgrade. Advanced Micro Devices up 6.1%. Citi put out a note saying that they are wildly bullish on chips, on demand, and AI. To the downside, though, Marathon, this is a little bit of a head scratcher, down 14%. They put up a good quarter. All was well, but I think it's the big rally into the report. Even including this decline, this stock is still up nearly 50% on the month, so some consolidation, major consolidation. Snowflake down 19%, disappointing revenue outlook, and a change in the C-suite, investors not liking it. Let's take a look at the month of February. Hard to believe that we're already at the end. Now, I'm guessing, Katie, you can guess, especially given the work that you did this morning earlier on the open, what this is. It is Bitcoin, up in a massive way, up about 50% on the month of February alone. In orange and white, we have the Russell 2000, the S&P 500, both up about 5 to 6% in the month of February. So a risk on month relative to stocks. The outlier, though, that happens to be banks. We have the KBW Bank Index down about 5% on that New York Community Bank Corp blow up on commercial real estate fears. Let's continue to keep an eye on that. And then finally, if we put it all together with the S&P 500, we have this index up now 4 months in a row. That is certainly a positive, and you can see here it is out of those October lows, higher highs. But what's so interesting, and we continue to point this out, Katie, is that the best RSI, the most bullish momentum that we had for the index was back in December. That's where the S&P 500 is. We have the S&P 500 significantly higher, well above 5,100, almost at 5,100. But the momentum is not as good. This tells us that weak hands are buying. At some point, those weak hands could fold out. But right now, that's not the case. We're looking at a bullish picture for the month of February.
Abigail, let me just say, for better or worse, I would recognize the Bitcoin chart almost anywhere. Bloomberg's Abigail Doolittle, thank you so much. Now coming up, repricing, what the Fed will do and where to invest. We'll hear from Lindsay Rosner of Goldman Sachs Asset Management up next. This is Bloomberg.